We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And welcome to our annual cyber panel at the Rendezvous. And I'm joined by an esteemed selection of panelists. First of all, we've got Brittany Baker, Vice President of Solution Consulting at CyberCube. Brittany, welcome. We've got Gavin Lillywhite, Operating Leader of EMEA for Exceedance. Gavin, welcome. And of course, we've got Erica Davis, Global Co-Head of Cyber at Guy Carpenter. Erica, good to see you. So here in Monte Carlo, lots of conversations always about cyber. And this year, there's a lot of talk about cyber pricing coming off its peaks. How do you perceive the supply and demand dynamics of the market? Erica, do you want to kick us off?
Sure. So we do see that the cyber market has continued to perform profitably as this line of business has matured. History has shown that the cyber market has also responded when a tipping point is reached in profitability. When we look at our analysis through 2021, the ultimate loss ratios remain fairly stable. And so while we've seen a small uptick, the line of business is still operating globally around an expected loss ratio of about 54%. So what that shows us is the market is still vibrant, it's still in a good place, and we are seeing fresh capital continue to enter the cyber market.
Gavin?
Yeah, so for me, it's an interesting one because I think any softening market is really due to obviously oversupply of capital if you think about basic economics, right? So if you're not growing the risk pool itself but you've got more providers bringing capacity in, then naturally that lends itself to a softening market. And I think the market's probably at a bit of an inflection point now, and an interesting one because pricing's never been cheaper, and yet there's a lot of talk around actually a number of clients and SMEs particularly are still not insured. So penetration rate's still quite low in some sectors. And I'm sure we can talk about the dynamics of pricing and capacity further later. But I think what's also interesting for me, when we saw CrowdStrike last year, I thought that might actually put a bit of a halt on pricing, but doesn't seem to have done. I guess you two ladies are probably closer to that than myself. But I would have expected that to have started to make people think, actually, we need to maybe have a bit of a rethink here in terms of the acceleration in price reductions.
Brittany?
Yeah, I'd agree with Erica and Gavin. What we're seeing from our clients is it's still a vibrant opportunity in the market. With pricing coming off from its peak, we are seeing folks, still invest in this market and develop tools to help expand their risk pool as they're looking at new geographies or trying to increase the SMEs that they're writing. So it's definitely been exciting to see folks starting to do newer things, even if the general market is talking about that pricing coming off a bit from its peak.
Lots to delve into there. Thank you. Let's talk about claims. A couple of you have mentioned claims. So at the same time that we're seeing pricing potentially coming down a bit, claims are continuing to rise. So what's the prognosis there? Yeah.
I mean, look, we definitely are seeing a small increase in frequency. We just released our latest CAT model update, and one of the things that was built into that was a small increase in the frequency, but it hasn't created a major shift in our models that we're working with the rest of the industry to do. So agree, but it hasn't been a complete landscape shift.
Erica, does that tally with what you're seeing?
Yeah, we too are seeing an increase in frequency and severity. There are regional drivers to some of those performance differences. North America is experiencing those risk dynamics a bit more robustly than rest of world is. So there are beginning to be diverging views of performance across those two regions. Maybe if I can just circle back to something Gavin said about CrowdStrike. There's been a number of recent headline events, particularly in 2024, that have shifted the view of what catastrophic risk could mean for the industry. But ultimately, when we look at the actual insurable loss dollars that resulted from the CrowdStrike event, it's really only about a 2-point movement in the loss ratio. So when you think of the non-cap pricing that these portfolios plan into their pricing models, and then you think of the catastrophic loads that I know Brittany and team are familiar with, they're generally much higher than something like 2 points. So that's why I think you didn't see that market reactivity as a result of that particular event, and actually the accumulation of some of those smaller scale catastrophes in the last 18 to 24 months.
Yeah, no, that's a fair point, but I think I was sort of coming at it more from sort of there was a bit of a oh my goodness, what's
It
this
was a
going to be?
headliner,
Because
yes.
let's face it, it's always the unknown and the accumulation aggregation from certainly from a primary insurer's perspective, and then also a reinsurer's perspective. So I thought it might have just sort of made people at least sort of think, well, actually, this could have been much worse. But I mean, interestingly, so I talk more from a UK perspective. What I see in the UK, we've had some big headlines like Marks and Spencer's, Co-op, Harrods, just recently JLR, where we start to see cessation of business. And for me, what's been very interesting is it turns the focus away from what I think has traditionally been more of a liability approach to cyber to a truly first-party loss. Because if we think of JLR was saying to people, we've been breached, we can't actually produce cars, we can't get supplies in, so stay at home. That is truly a first-party risk. So I think, for me, and interesting like Marks and Spencer's, I think, if I remember rightly, they bought a tower of about 100 million, which was led by Allianz, I believe. And, but that loss expectancy was around about 300 million the last time I saw. So the interesting for me is that this also really shines a light on the inadequacy of the limits that clients are buying for the actual risk that they actually have on their balance sheet.
One of the things I was just going to comment on, as you said, kind of unexpected when it comes to CrowdStrike. And I think maybe from an enterprise point of view, companies looking around saying, oh, I didn't think this could happen to me. I totally agree. Education of enterprises is something that teams have been working on, and brokers for sure, the retail brokers have been working on for a while, and those types of events I think help their cause to say it happened to them, it could happen to you. From a modeling standpoint, it's not unexpected, and that's what we always like to see is, all right, we've considered that, it's in the model, maybe it looked a little bit different, but it was built in. So that was just what I was going to add on there.
Yeah, I mean, I definitely agree with Brittany's points. Like these are actually positive developments in the market, right? They bring real life scenarios to the buying community, as well as to reinsurers who evaluate large aggregation risks. And again, when we sort of look at the CrowdStrike and those sort of things bringing attention, those events that are bringing attention to the overall market, they actually help to build a credible data set, right, to work off of. And I know that looking at some of those real life scenarios helped to refresh some of the aggregation models and bake in some of those the outcomes of those events and improve those models going forward for the market.
So cyber cover is reliant on reinsurance protection to a large degree. So what developments have we seen amongst reinsurance in recent months, and perhaps what can we expect to see in the future? Erica, do you want to?
Sure, I can start with that one. I think the most notable change over the last 12 months has been greater optionality for buyers. I think as a market, we've collectively heard, what cyber writers are looking to cover, how their concerns and buying behaviors are maturing and shifting, right? And that's not just in light of their own portfolio performance, but it's also about greater sort of more maturity as these portfolios grow, and it's also in response to some of the recent events that we were talking about. So reinsurers, I think, have been really receptive to those sort of stratified, like expanded range of options. We have risk XOLs that are garnering more interest from clients and appetite from markets, so that's a positive. We're seeing more proprietary structures enter the market that are attempting to address some of the basis risk that pure event covers can sometimes present. And so we have really seen reinsurers come to the table and help support those. Now, obviously, that comes with information exchange and education. So we've spent a lot of time at Guy Carpenter working through that process with the market, but have been pleased with the way they've come to the table with that capacity.
Yeah, so from my perspective, rather than sort of noting what reinsurers have done, I'd probably like to focus a little bit more on what I'd like to see from my old role, where we were focusing a lot on cyber physical damage to assets that are not insured under a cyber policy. And I think this is still a great opportunity, I really do. The challenge, candidly, is that property underwriters and energy underwriters are what they are, and cyber underwriters are what they are. Never the twain shall meet. That's the challenge. So bringing the two together, and we're doing a lot of work in my old role around assessing, quantifying that loss expectancy. So whilst it's remote, there is still a risk there, you know, and we were modelling some pretty chunky loss expectancies for smart offices, big real estate offices, machinery plant. If you think about power generation, offshore renewables, that kind of stuff. So I think that's the big area where I think reinsurers can really play a big part, because they really understand tangible risk and first-party risk, bringing in expertise around cyber as well, and bringing the two together, I think, is a massive opportunity for reinsurers.
Yeah, I think one of the things that we're seeing also, Erica mentioned information exchange, and, reinsurers are always going to have less data than the primary carriers. That's just a fact of life in this industry. And cyber has kind of suffered from an increase of that compared to other lines, but it's getting better. And as reinsurers are getting more data, they're starting to say, right, well, what else can I do with this beyond, the typical workflows that we have, and one of the things we're seeing is they're able to now start to use security data and really differentiate cedents from that point of view. And it's early days for sure, but I think that's an interesting trend that we're seeing. So beyond the loss modeling and providing new structures, having that view of security, posture, and hygiene at a portfolio level is really cool to see.
Maybe if I can add on to that too, I think differentiation is an area where reinsurers have definitely shifted, right, over the last 12 months or so, and we're really seeing specific and distinct market appetites develop, and a lot of value being placed on diversification of the books as a whole. So like as you have these underwriting strategies develop over time, right, now you have reinsurers who are assessing that diversification, whether it be in more SME business being written, or talking about some of those regional drivers, like having preferred views, right, of certain regions where they can expand the business has been helpful.
I guess, as with many exposures, the US has largely led the way in the provision and the purchase of cyber cover. What advances are we seeing in other parts of the world? Gavin, do you want to kick us off on that one?
So I think you're exactly right. US was very much at the forefront of cyber risk, and both in terms of understanding, appreciating the risk, and I think candidly that was driven by federal government. So I think, if I'm honest, I think we start to see EU, UK starting to increase awareness, if you like, of risk. I think the only thing I would say is that I do think it's maybe gone off the political scale a little bit compared to where it was, partly maybe because of obviously Trump coming into the US, where it was sort of deprioritized as well. But I do think there is greater awareness, but still more to do. And interesting for me, earlier this year, we actually in my old role, we actually met with Treasury and said, look, this is the risk that you're facing with regard to physical assets, and there was an acceptance, but unfortunately it's like just goes to the pile. So yeah, I think that's the challenge.
Brilliant. Do you have a sense of how the cyber market is developing ex-US?
Yeah, absolutely. I think outside of the US, UK, where we see low penetration rates but much higher relative to the rest of the world, we're starting to hear a lot more interest in APAC. In India, that's definitely a really growing market. And we're hearing that really from the beginning of the value chain, at least from where we're sitting, from retail and wholesale brokers who are talking to those end consumers of this product and wanting to be able to bring them a product that is helpful. And, we're seeing events happen. One of the reasons the U.S. also is kind of leading the way here is because a lot of events happen to U.S. companies, and we're seeing that unfortunately spread more across the world. And when companies are experiencing those events, now all of a sudden there's something to talk about, makes it tangible, like Erica said earlier.
Erica, you're going to have some thoughts on this.
Yeah, always. I think that when we look at sort of regional dynamics and market growth, we're definitely finding that rest of world is outpacing growth compared to North America. According to our numbers, rest of world is 36% of the overall global market, so much higher than it previously was. The loss experience, like Brittany noted, is more benign in rest of world. Generally speaking, it's about 7 points better in terms of performance than in North America. So for that reason, you have a lot of cyber riders who are looking to expand their presence there. It is worth noting that from a pricing environment, rest of world is actually facing more rate pressure than the U.S. right now, whereas U.S. rates, I believe, declined 3 points as of mid-year 2025. There's still double-digit increases throughout Europe and UK, a little bit less in Asia. So I think there's going to be some pricing pressures. There's recognition around outperformance, but continued to see outpaced growth.
So just finally, it would be absolutely remiss of me not to mention the hot topic, which is AI. AI, I guess, particularly for the cyber market, presents opportunities, also presents perhaps more obvious challenges than for other sectors. Give us a quick sense of what the opportunities and the challenges are from AI. Brittany, do you want to kick us off?
Yeah, I think for us, what we're doing, we're always in research mode and thinking, all right, well, how should this and how will this impact models going forward so that we are appropriately serving our clients, whether they be retail brokers all the way up through the reinsurers across that value chain. And we never want to get ahead of the buzz and put something in a model that doesn't make sense. So I think for the insurance industry, it's understanding, are there frequency severity trends that are changing and fully shifting the landscape outside of the buzzwords that we're all talking about? Are there new single points of failure? I think it was too early to put that in our latest model update, but we will see that in the future. And that's beyond even, the products themselves and the policies and how they should be written. So I'm curious to hear your guys' take on that.
Yeah, so I mean, it's an interesting one, right? I think we're probably, to be fair, at the beginning of the journey, right? So I think there's two things to it. One is the risk that it brings to the balance sheet for insurers and reinsurers, but there's also the positive in that AI can also be used, and I'm sure you already do, to actually revalidate the models and revalidate scenarios, because it also brings benefits as well as challenges, right? Hopefully those benefits outweigh challenges. But I think certainly, if we think about particularly liability and the overall concept of tort, for example, that's a big challenge for both cyber liability and general liability, which is still to be played out. And as I say, I think we're very much at the beginning of that journey.
Those are both really good points. I agree, just in terms of assessing AI capabilities, both offensively and defensively. Certainly offensively, threat actors are going to continue to leverage AI to have broader scale impacts, longer dwell time, more large sort of exfiltration events. And that's going to be challenging, right, when we assess cyber risk as a whole. But it can be used defensively too. And there's instances where it's able to better detect malicious activity. Obviously, that's going to require investment, right, by businesses and cyber riders alike. But overall, yeah, there's some trends to watch. We're seeing AI utilized in ways like making strategic decisions, telling you which data is most valuable to exfiltrate, making recommendations on extortion demands. So there's no doubt that this is going to present a new era of risk for us going forward, and opportunity.
That's a good note to end. Thank you very much indeed, all of you, for joining us today.
Thank you.
For AM Best TV, I'm Richard Banks.